Right now, we are at historically low and artificially low interest rates, and have mostly been ever since the Great Financial Crisis in 2008. Today, I'll discuss why the Fed will likely need to raise rates regardless of the state of the economy within the next 2 years, as well as what this means for the economy as a whole, so stay tuned. Hi everybody, welcome back to The Contrarian. My name's Logan. I really like to talk about overall success, investing, having your money make money for you. I also like to talk about issues surrounding the issue of crowd behavior, how crowds tend to almost always get things wrong when they get really wrapped up and emotional about a subject. So if you like those topics, please hit the subscribe and like button. It continues to help me make content like this. For starters, let's look at how abnormal this has been over the last 10 to 11 years to have such low interest rates. It's obviously much lower than what is normal. Just looking at the average chart, or the chart of what it's been for the last 50, 60 years, it's very abnormal what we've had than what the free market would make. Obviously, nobody would lend their money to receive 1 or 2% back annually when inflation is 2 to 5%. That's actually a real negative rate because you have to subtract the rate of inflation from your rate of return. And they definitely are not going to be loaning any money if they're losing money, if there are negative interest rates. And the fact that it has been kept suppressed and artificially low from 2009 to 2015, and then from 2018 until now, should show that we never really recovered from the previous crash in 2008. In fact, when Jerome Powell, the current chairman of the Federal Reserve, tried to restore interest rates to a more stable position, the stock market began correcting heavily in late 2018. The stock market only stopped crashing then and has gone up since because rates were again cut, and the Fed promised not to raise rates. Since the global shutdown, obviously, and the economy being put in jeopardy, the Fed has further cut rates back to nearly 0%. However, this is a terrible position to be in before a recession. In order to help in recovering from a recession, the Fed has one of two options: lower interest rates or print more money. The Fed does this to avoid a deflationary environment such as what happened during the Great Depression. This is because deflation generally leads to a much longer recovery period for an economy, with the appreciation of the dollar causing decreasing prices, causing a decrease in consumer spending. This tends to lead to more appreciation in the dollar, and more decreases in pricing, and then more decreases in consumer spending. So it tends to downward spiral in this direction. So in order to prevent this, they need to cut interest rates to make money more cheap to borrow, or they need to print more money to cause inflation. The trouble is they're already at 0%. They will need to go negative in their interest rates in order to have the same effect, but the issue is, when going negative, banks have no incentive to loan money. In fact, they have the incentive to do the opposite. This makes cutting interest rates ineffective at making money cheaper to borrow, since nobody is loaning money to begin with. So the Fed will need to do more of what it already has done, printing more money. The drawback to printing money is that it doesn't have the intended effect of stimulating the economy. For example, the majority of the first wave of stimulus went either into the balances of large companies and hedge funds who didn't need it in the first place, and consumer savings. Consumers aren't spending in such a risky economy, and saving rates are at all-time highs. While this is good for consumers, putting them in more stable positions than they were in, it makes money printing ineffective at stimulating the economy and preventing deflation. What this inevitably means is that deflation will still happen regardless of how much money the Fed prints or how negative they go with interest rates. Nothing can stop it at this point. Banks won't loan money, and the stock market, real estate, and bond markets will suffer heavily as people pull money out of assets and pile it in cash. When inflation finally does happen, it will hit in a sudden way, forcing the Fed to raise interest rates or face the demise of the dollar as the global reserve currency. This is the fundamental reason they will need to raise interest rates. Irregardless of the state of the economy, they have no other option. Either they raise the interest rates in a weak economy, or the value of the dollar plummets due to all of the money printing they did during the deflationary period, trying to prevent deflation. This is the fundamental reason why I see no other option for the Fed but to inevitably raise interest rates massively to combat hyperinflation in the next 2 years. So what does this mean for the economy? First of all, I ask that you don't take any of this as personal investment advice. This is just me as an amateur investor talking about this on my YouTube channel. But I see the upcoming effects as following. The stock market continuing to rally on stimulus until roughly the end of this year, 2020. Then the full economic effects of such terrible business bankruptcies and unemployment suddenly hit the stock market, driving it down below what we saw in March. Now you might be asking, why do I see it falling so heavily, going back under the lows that we saw in March? And this is mainly due to all of the leverage in the markets I see right now. It's just unable for hedge funds, for banks, for investors to deleverage without this sort of drop happening. Housing will also be largely hit as a result of this massive wealth destruction. Commercial real estate will definitely be hit the hardest as businesses fail. The dollar will briefly rise in value during this deflationary period, and I actually see gold and other, stores of value, potentially Bitcoin, falling in value. All this then presents the buying opportunities of a lifetime. It's definitely only during this time period and only during arguably the Great Depression that we're having this good of buying opportunities. Everything will be heavily discounted, but also extreme negative consumer sentiment. Massive inflation will then happen as the market recovers and prices in all of the money that has been printed. So what to do right now? I personally am only buying fundamentally sound companies, if at all, buying them. And I would only recommend staying out of current funny money markets, all these current strange companies with zero sales, zero revenue that are, trading at billion times their market value. It's just funny money. The market's really lost its mind, so I would completely stay out of that if I were you. There's no telling when those bubbles will crash, but they definitely will crash, and it will not be good for those who are still left in them. So if you like this video, if you like content like this, please hit the subscribe and like button. I know it isn't a very upbuilding video, but I'm trying to let you guys know what I think. Let me know what you think of this as well. If you think I'm wrong, let me know why in the comments below. But yeah, I hope to see you again.